Welcome back to Lunch at the Market. With Brad on a plane, it's up to me to bring you what we have today. Thanks to the modern miracle of satellite internet in the air, we're able to watch the markets from just about anywhere. This reminds me of the satellite phone companies Jim Cramer featured on Mad Money not too long ago after a caller brought up one of the two players in the space. I'll have to go pull the tape to find out what those two companies were. They may just be worth a second look on today's nice little pullback. This market couldn't have been any more textbook that we've played it. Yesterday, we shared with you the levels on the S&P 500 that we were looking at, and the 1330 level was the level to take some off the table. Now, only an hour or so into the trading day, it's impossible to tell whether we'll get a full repeal of the sell-off from the open. Gosh knows, in the market, just about anything is possible, but being ready for the sell-off this morning was the right move in yesterday's rocket ship session. There's a downgrade from Goldman Sachs today, and if the stock goes under $160 a share, that's the buying point you're waiting for. One analyst on CNBC noted this morning that Goldman Sachs, GS, has a tremendous amount of liquidity on its balance sheet and every reason in the world to buy back their stock after the bashing they've taken over the last 2 years. The stock itself is down around 1% over the last 12 months, but there have been terrific buying points along the way for investors who are willing to ignore all the media beatings the company took. GS is levered to healthy capital markets, and we think they have just that. There are trading opportunities in currencies, commodities, bonds, and certainly stocks these days. All of this is bullish for GS, and under 160, we think you want to be long. Don't forget to take a look at a deep in-the-money call strategy to avoid having to put $16,000 on the table for 100 shares of the stock. You'll get the same upside with less downside, and you can add options around the position as the price action dictates. It's nice to see NetFlix, NFLX, with a very nice pop today. We are sad to say that we are already down and out on the 210-205 put spreads, but with the theta eating away at the options prices out of the money options, there's simply too much risk in staying short the 210-205 put spreads with only 2 weeks to go, and the stock trading around 203 and change. Thanks to today's pop, the 205-200, 200-195, and 190-185 put spreads are in terrific shape. We may even start looking to take these off next week when theta goes from third gear to fourth gear. Moves like this are exactly why we continue to like shorting put spreads on high beta names with terrific underlying businesses. A note on AMZN.com and their foray into Netflix territory revealed that not charging anything extra to add streaming content to Amazon Prime memberships is going to do little but cut into the margins of Amazon. This doesn't even take into account the rising cost of content that Amazon will have to deal with in order to get a library anywhere near what Netflix can offer. Netflix is also available on nearly every internet-enabled device, while Amazon is really only available where the internet is being accessed directly. For Amazon to catch up to Netflix, it's going to take a significant capital commitment from Amazon to catch up. For Netflix can do things like buy a content maker like Stars and have it be accretive, while a similar purchase by Amazon would be best referred to as distracting. Think about Google's foray into the hardware market with their own Android phone hardware. That didn't go too well or last very long, while owners of Netflix stock, which has been a virtual monopoly, should always be concerned about competition, and there probably will be legitimate competition down the road. They probably don't have to run screaming for the exits today. As with all high beta stocks, especially those that are much loved and hated as Apple, Netflix, Akamai, CRM, CMG, Amazon, and others, always exercise a healthy skepticism and a dose of caution. We don't recommend anything like shorting naked calls or puts on names like these unless you want an excuse to sell your house to pay for the margin call. But doing your research, employing hedging strategies when price action dictates, and sticking to your guns when your story for owning the stock is still intact are all good ways to profit from these names, especially over emotional price action gives you a great entry point. We're happy to be able to get you a lunch at the markets today, and we hope everything gets as much out of what we put together as the effort necessary to put it together. Have a great weekend. Remember to keep your eyes on your cash position and any stocks or other positions that you really should be eliminating. This isn't a market to have positions in names that your conviction isn't what it should be. If you're waiting for a loser to come back, and if you were honest with yourself that a name just might not come back, it's probably time to say adios to that name. Have a great weekend. Remember, when we get back on Monday, theta will have done its dirty work over the weekend. It'll be time to start managing those short options positions. Don't forget to be on the lookout next week for James Altucher's second episode on America's Favorite Traders on iTunes and our website on magnumopusfinancial.com. Be safe, do homework this weekend on your portfolio, and watch your list. And we'll see you on Monday.